STMicroelectronics is a fast-growing semiconductor manufacturer that has a price-to-earnings ratio of 10. Now that catches my attention. But usually when something looks too good to be true, it probably is. So let's try to find out, is STM a great investment opportunity or a trap? It designs, manufactures, and sells semiconductor products worldwide. The company serves automotive, industrial, personal electronics, and communication equipment sectors. STMicroelectronics is headquartered in Switzerland. So we have here a combination of possible fast growth and a relatively low price. That is very interesting. However, it is not all rosy. Chinese authorities are limiting the use of foreign smartphones and tablets, which will definitely affect STM. In their recent earnings call, the company projected significant growth in their automotive business, but they also anticipated a decline in the industrial market. So let's analyze and value STM and really understand this situation. If you were to invest $1,000 into this company 10 years ago, you could buy around 120 shares. And now they would be worth something close to $5,390. And this company also pays dividends. So in that time you would get $322 as dividends. So if we add together those numbers, we get $5,712. And that is a gain of 471% in 10 years. That is a nice result. However, for some irrational and unexplained reason, future results are not always the same as past results. I don't know why that is, because investing would be just so much simpler that way. But, well, it is what it is, and unfortunately, we have to analyze the company itself to make educated guesses about its future growth. Individual insiders, that is an X, almost exactly 0% of the company is owned by individual insiders. And are those insiders that own this 0.00001% of shares buying right now? That is an X. We see that one insider is selling the stock every quarter. That does not represent a lot of belief in the future of the company from its management. And do super investors own this company? That is an X. There are no super investors owning this company, and of course that means that they are also not buying the stock. Not a great beginning. Return on invested capital. That is a check at 11.8% 10-year median returns, and we want to see this number higher than 10%, so it's a decent return. And what do we know about net profit margin? It is a check at 24.4%. And when we look at the big players in the industry, we see that Micron has a margin of minus 42.5%, Intel 3.1%, AMD 3.7%, Taiwan Semiconductor Manufacturing Company 38.8%, and Nvidia 48.8%. So STM is rather close to the front of the race. And now let's take a look at share buyback. It is an X. In the last 10 years, they issued 1.8% extra shares. So they are diluting long-term investors, but not by much. And the debt? It is a check. It would take 1.5 years to pay the long-term debt with a current free cash flow. And that is without taking into consideration the cash they have in the bank, which is actually bigger than the long-term debt itself. Revenue growth. that is an X at 7.9% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so it's not that far off, but it's not great. And free cash flow growth, that is a check at 26% in the last 9 years. Now, that is much better. And earnings per share growth, that is also a check at 47%. Okay, so the company is healthy and its growth, especially earnings per share, is quite nice. But if you would like to learn which of all the companies analyzed on this channel is the fastest growing one or has the best financial health, you can do that by becoming a Patreon and getting access to our brand new Stock Ranking Pro. Yes, I stole the Pro from Apple products. So in the stock ranking, you get all the data we show during our videos and you can sort companies by all of them. But in the Pro version, every company is awarded a score for valuation, financial health, growth, dividends, investors, and also overall score to easily find great companies. And overall score with valuation to find great companies that are currently nicely priced. I may be a little bit biased, but I really think it is great. I love using it, and because it is updated every month, you can really make sure you will not miss a great investment opportunity. If that sounds like something you would like to try out, then head over to our Patreon page and join this great community of investors. The dividend yield is 0.5%, so in the next year, shareholders should get 24 cents per share through dividends. And the payout ratio, that is an X at 5.4%. And we want to see the payout ratio somewhere between 20 and 50%. So it is a very safe dividend. But we could expect to get a bigger portion of the earnings. But then again, considering the fast growth of this company, it is actually surprising that they are paying any dividends. And what about dividend growth? It is an X at 0% 5-year growth rate. As you can see, the history of this dividend is very unpredictable. It goes up and down all the time. So in this case, I would not concentrate on the dividend at all. Just treat it as a cherry on top. Price to earnings ratio is just 10, so very low. But to properly value this company, we will use a discounted cash flow formula and we will create 3 scenarios of its future growth. So in the low scenario, we will estimate a growth of 9% for the first 5 years and then 8%. In the medium, 12% and then 10%. And in the high scenario, 16% and then 12% growth. So the low scenario is close to its revenue growth. Medium is close to a predicted growth of the semiconductor industry, which is 12.3% till 2032. And the high one is illustrating a story in which this company will do a little bit better than the market. So with such estimates, the intrinsic value in the low scenario is $40, in the medium $48, and in the high scenario $61. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that makes you feel safe, that gives you enough room for mistakes. So with such a margin, we get in the low scenario $28, in the medium $34, and in the high one $42. And the current price is around $44. So maybe it's not quite there, but it is probably not that far off a fair value at the moment. Looking at its financial health and also growth and comparing that to the current valuation, well, I have to say that as a long-term investment, it can be interesting. But we have to remember what was said at the recent earnings call, because the next year or two may be very bumpy. But if we are willing to go through some tough times, it may be an opportunity to buy a strong, healthy company with a nice growth potential at a fair price. If you enjoyed this video, you may want to check out my analysis of Super Microcomputer Incorporated. Thank you so much for watching and see you in the next one.